The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Thanks for joining us this evening on our annual Fireside Chat program. Thanks for joining us. It is Wednesday, the 20th of December 2023. It's 6:01 p.m. Chicago time, 7:01 Eastern. We have a lot packed in for you here today, as you can see on the screen. I want to remind you that trading derivatives is not suitable for all investors. Past performance is not necessarily indicative of future results. And of course, the opinions of the speakers are their own and do not necessarily reflect the opinions of Convergent Trading and its officers. So today, what do we have? We're going to start out with a little intro of who Convergent is. You may or may not know. We're going to talk to Bob Elliott, who is the CEO CIO of Unlimited Funds. We're going to talk macro with him. Then we're going to get into zero DTE and Gex trading and how that impacts S&P futures trading, which many of you are doing with Jasper of Gexbot. Then we're going to talk about taking stock and setting goals with Jared Tendler, the performance coach and top selling author for trading and golfing psychology books. And then at the end of it, we're going to talk markets with Brian and John Pierre Nunzi from Convergent Trading. So let's get going here. Let's bring on our friend Bob. Bob, are you with us?
Hey, how's it going?
Hey, Bob, thanks for taking the time to join us here in your busy schedule. So there's a lot to cover. It's been a heck of a year. I was very happy to meet you earlier in the year on a futures radio show with Crudelli, and I really loved your perspective on how the flow of the fundamental data was going and what the Fed was looking at. So let's just start out by talking about what you do, what is Unlimited Funds, and then we'll get into it.
Yeah, I mean, I've basically been a systematic investor for 20 years, particularly focused on macro investing, and during that time, was on the investment committee at Bridgewater Associates, which is the world's largest hedge fund, and helped. It was one of the small handful of investors that helped take Bridgewater from being the challenger to the incumbent in the space. After I left Bridgewater a few years ago, I started to think hard about whether there's a way to make those sorts of hedge fund style returns available to every investor, and started Unlimited with the idea of basically using technology to infer what hedge fund managers are doing in close to real time, and with that understanding, translate in long and short positions in low cost index securities, which allows us to then be able to package them into an ETF wrapper. And so our first product, the HFND ETF, has been on the market for about 15 months, seeks to replicate the gross of fees returns of the hedge fund industry. And really, it's about making hedge fund style returns available for everyone. The other thing that's very interesting about that is I get real insight through our technology into how all these hedge funds are positioned and how they're shifting, which is a very useful lens in the combined with the context of looking at the day-to-day macro flow that's going on.
So how, hedge funds, it's not like tracking the S&P 500 or anything. It's not like a standard thing. How is it that you can track such a massive variety of managers and so on through one ETF? Not that you're going to tell us your secret sauce, but as an investor in your fund, how do I get a sense that you are tracking what these funds are doing?
Yeah, there's a lot of performance information out there about how hedge funds are doing, and what we're trying to do with our funds is track the gross of fees returns of a variety. We basically just average a bunch of different hedge fund indices that are all pretty similar, but have their own nuances to them. So things like HFRI or the Credit Suisse Hedge Fund Index, indices like that we do. But what we do is, in terms of our target, is we add back the fees so that so that we're targeting a higher return than what's sort of on the page. And that's because hedge fund strategies, before the fees are actually quite good, in line with stocks or a bit better than that, with half the monthly volatility and about a third of the drawdowns. The problem is they charge too high a fees. And so by using technology to basically replicate what they're doing, we can offer it a much lower fee structure and a much more tax efficient structure, for everyone in the ETF wrapper. And basically the way that we do it at some level is pretty simple, which is we look at the major hedge fund styles, and you're right, there's 3,000 managers in the hedge fund universe, but they really boil down to about 6 different styles, core styles that they're approaching it, like equity, long, short, global, macro, fixed income strategies, etc. And at the index level, we can take the understanding of their returns, compare that to the assets they could plausibly have been invested in, and basically back out how they're positioned using a combination of our wealth of experience, having done this for a long time, with some modern machine learning approaches, which is really just a way to do that in a computationally rigorous way. So that's what we're doing. And what you see in the market today is essentially an index fund, AUM weighting all those main strategies, trading basically the 60 most liquid markets in the world, give or take.
Amazing. So let's get into it with the macro here. When you look at the current year, can you, and feel free to grab a sip whenever you like, can you summarize the key milestones that you have come across for this year? What goes into your diary for 2023?
Well, I think if we just start where we were at the beginning of the year, which was basically everyone was all in on recession now, and we get to the end of the year, and the unemployment rate is still at secular lows, and growth is still well above potential, and stocks are making new highs, and bond yields have risen. And so just taking a step back, like the basic dynamic that we're seeing right now is a very slow moving slowing of the macro economy. And that's actually pretty normal. Like usually macro cycles take a long time to play out, and this one is no different. And if anything, it's a little slower because it's a little less sensitive to the tightening cycle that's occurred, given the terming out of debt and things like that when rates were very low and liquidity was plentiful. So we basically have this very glacial move in the macroeconomy. And if we look back through the course of the year, what we've seen is extremely volatile expectations, right? So we went coming into the year, expectations of a recession now. That didn't translate. We went to higher for longer. Then we had SVB and it came down. Then we had, an AI productivity boom and higher for longer again. Then we had a shift back as, people were concerned that there would be, too much tightening in the market, plus the Fed and the Treasury eased. And then we get to today where basically the expectation is, well, in some ways it's a bit odd. It's pricing in the perfect soft landing with huge interest rate cuts over the course of 24, but at the same time, stocks making new highs, right? So basically the market's saying we're going to have 160, 170 basis points of cuts, and stocks keep pushing higher. And that's kind of the perfect, it's the softest, 100% perfection of the softest of the soft landings that could ever occur is priced into markets right now.
So much fun was made of Treasury Secretary Yellen and Fed President Powell throughout the year last year about this soft landing thing. I mean, I can't tell you how many macro type people come on and say there's no way we're going to get a soft landing. It's going to be a crash. And lo and behold, the people who are supposedly don't know so much or can't really control things have managed to land us all softly. In general, how does this translate into the first 6 months of 2024? I know we can't see far beyond that, but I know the market was pricing in some cuts in the Fed fund futures. There were bets that around May, June, we would start seeing cuts, and that's moved up actually to March now since last Wednesday when the FOMC came out. What's your perspective going into 2024?
Well, I think the main thing when I look across the markets is that in terms of the current pricing, you always, when you're trading macro markets, you got to start with the current pricing because that's what you're trading. That's what you're buying is a path of future expectations in the markets. And let's start very straightforwardly with the short rate market, which is now pricing in, just looking at a quote right now, basically 160 basis points of easing, between 160 and 170 basis points, depending on how you look at it. That would be a very substantial easing that would have to come in order just to meet market expectations. Now, to be long short rates, long 2-year bonds, you basically have to expect something even more, even greater cuts than that. And really, when you look at the overall sort of distribution of those expectations, there's a greater than 30% expectation that interest rates, short rates, will be below 3% by the end of next year. Now, that's a pretty remarkable thought process because what that implies is basically a crash landing in the economy that's meaningfully influencing people's expectations of future monetary policy. And that's coming at a time when everything, frankly, from a macro perspective, is pointing in the opposite direction, right? Stocks are making new highs. We've had a 100 basis point plus move down in bond yields and even more in mortgage rates. The economy, is growing at potential or better based upon the data that existed before we got this big market-based easing, and unemployment is at secular lows. You put that all together, typically that would not align with an immediate crash in the economy the way the short rate market is priced. And so I think that's probably the biggest tension point is we're probably going to see a pretty good economy coming in to the first 6 months, let's say, of the year. There's no reason to believe that we're not going to have a decent economic set of conditions. And that's going to cause, I think, a lot of conflict with the massive cuts being priced into the short rate market, which should put pressure on bonds, in particular relative to stocks, and on short rates to go higher in the new year.
When you say looking at the short end of the market, pricing in 160 basis points, how far out? Is there an indication of how far out that's being priced in?
Yeah, that's December 24 SOFRs is what I'm focused on. So which is essentially what the Fed rate will be on December of 24. So 12 months forward, what the short-term Fed funds rate. And it's actually the 3-month rate, but whatever. It's a basic rate.
Okay, so what will the key inputs? So, most of our audience, including myself, we're day trading futures. We're actively trading futures. And we've known all year that what do you pay attention to? You pay very particular attention to what Fed speakers say, especially some particular ones. They can really, for somebody who's trading a fund or is more managing a fund, you don't really care about what's going on intraday. We live and die by the intraday.
Yeah.
So there was a lot of attention to that. There's a lot of attention to anything and everything that has to do with inflation, any inflation component of Michigan sentiment, the inflation numbers themselves, CPI, PPI, and so on. Going into 2024 with us knowing that inflation has been incredibly cooperative since the Fed started tightening, what are you going to be? Are you shifting what you're going to pay close attention to going into 2024? Is it the same thing as in 2023 where it's all about Fed, what they do and so on, or does it shift to employment, or does it shift to productivity, or what does that look like for you?
Well, I think my main focus, given the way the market is set up right now, and in particular the growth expectations in the market, the inflation expectations, like mostly inflation expectations have been that the inflation will come down to 2% relatively swiftly. I think on the margin, the incremental information has been a bit softer than the initial expectation, but I think most at this point that's basically priced. Like the inflation back to 2% is priced into the market, it's reflected in the market, and I think it's going to be hard. At least certainly on the downside, I think it's going to be challenging to get meaningful surprises on inflation. Now, I think the risk on inflation is that we could get upside surprises, meaning for whatever reason, inflation comes in a little hotter than people expect. And if we remember, Chairman Powell almost a year ago on February 1st, declared mission accomplished, and then there was a restatement of inflation being higher, and he had to eat his words like 6 weeks later. So, I'm not saying I have no predictive ability about whether that's going to get restated, seasonal adjustments and stuff like that. That's, I don't know, it's choppy stuff. But I certainly, like, everyone's all in on perfect 2% inflation. And my guess is it'll be kind of like that, at least for the first 6 months of the year, and not that interesting. And so then I think the attention is really going to turn to growth and whether growth conditions are aligning with the massive bid in bonds that we're seeing. Because the only way, bond short rates are expected to be at 350 in 12 months, and bonds are rallying through 3.8 is it's not just an inflation story. The inflation story is done. It's priced. It's in there already, right? It's that you have to have a growth compression, a huge growth compression. And I think more likely than not, and with that huge growth compression, that will give the Fed the catalyst to ease aggressively, right? You have to have deteriorating growth for a central bank to ease aggressively. And so I think that's where all the eyes are going to be on. My guess is we'll see a bunch of upside surprises. Like every day will come in and it'll be like the recent retail sales report, which is like, everyone thought it would be terrible, and then it was pretty good. And then, the next report and the next report and the next report. And that's going to really, I think it's the sort of thing that, no one data point is necessarily going to spook the market in one direction, but it's just going to keep coming that growth is kind of okay to good.
Okay, so it sounds a whole lot like a short squeeze. Explain to me, like I'm 5, this thing where they say the Fed is going to grow more and more concerned about real rates versus yields, I think is what. Can you explain what that is? What is the concern there that the Fed may have to act more swiftly?
Well, I'll explain it like you're 5. I mean, here's the basic idea, which is in general, you want to think about real rates, to think about whether interest rates are high or low in an economy. At the extreme, it makes a lot of sense that you do this. For instance, if interest rates were 10% and inflation was 0 and your wage growth was 0, that would be a very high interest rate relative to the income you could plausibly earn. But if interest rates are 10% and your wages are growing at 10% a year, well, that's a very different story, right? Because your wages, your income is growing about as fast as your financing costs. That's at the extreme. It makes a lot of sense to think about that. I think one of the challenges here is that a very academic Fed is thinking about this on the margin. So they're looking at something and they're saying, well, the current interest rate is 5.5, and inflation was 5, and then it's going to become 3, and therefore the real interest rate has risen. And that, in an academic sense, means a tightening in the way that I just described before in the illustrative example. But like, to who? Like, in what way does that actually create the tightening? Like, I think this is a place where the Fed is like, the academics are running amok rather than people who like actually live and breathe in the real world. Like, what happens? Let's say, wages don't move that fast. So wage growth is about 5% in the economy, give or take, right? If inflation goes from 5 to 2 or 5 to 3, you actually feel better, not worse, right? Your real spending power increases. And so in a very short-term time frame, or over a time frame that the Fed really cares about, like, falling inflation and stable income is actually stimulative, not tightening.
Yeah,
right? Because people will feel like they have more spending power. but yet the academics running around saying, well, I've got this paper and this model and these, frankly, like pretty bad disconnected thoughts are sitting there saying, well, it should lead to an easing. And so I think that's the tension point, is that they think it's a tightening at a time when it actually the exact opposite is true, given the fact that wage growth is not likely to change very fast in response to falling inflation.
Got it. Okay. If you were a betting man,
that's all I am, as a betting man, every day. That's what we do in markets. We bet.
let's just
we're like socially acceptable gamblers, right? That's what we are.
Well, we're gamblers with a very we have a very good story for why we gamble.
That's right. That's right. Yeah, socially acceptable. We're
Right.
smart. We're smart gamblers.
But I bet you don't trade volatility. And my question would be, looking at volatility going into the year, from what you described earlier, it would seem like we're probably going to continue to see this volatility compression go on as the market kind of ekes its way up, because the growth story is not slowing down as fast as the market, as fast as some people might have expected, yelling recession from the top of the highest mountains and all that stuff. For the first half of the year, what's your view on volatility?
I mean, it's probably going to be a pretty benign environment. Now, look, volatility is priced, about as benignly as I can remember at this point, right? In terms of, what the actual, like what the VIX is and stuff like that. It's like it's very, very low. It's certainly very low. And frankly, like about as complacent. Last time I feel like I've seen volatility this complacent was back in sort of the 2005, 2006, carry trading days, when everyone, thought that there was no risk of anything happening. Of course, we know what happened then, which was not that great. No, I think I'm not predicting that. I'm not predicting a financial crisis to occur again. But it has that sort of feel where everyone's like, well, in particular, the Fed put is struck very high, at a very high level. Now, I admit, like, the Fed put was a bit surprising to me, that they basically brought in the put at about a 15% stock decline when stocks were just off of all-time highs. That's surprising. But the volatility market is reflective of that. And until you get a circumstance which is going to force the Fed to do something more aggressively, particularly on inflation or, overheating in the economy, it's not clear to me that they aren't going to keep that Fed put kind of at that point, which means that, volatility is going to remain very depressed. At some point it can't, I guess it can get priced to even lower than it is, but, the skew certainly looks to the upside at this point, but, there's not a lot of catalysts to move it there right now.
For someone like you who's running a fund, is volatility, how does volatility impact you? If it rises a little bit, this afternoon we saw the indices tumble, but over the last 2.5, 3 weeks, we saw the S&P shoot up 200 points also to new highs of the year. How does that impact you? Do you see that more as yum, I get to pick up more on the long side at cheaper prices, or is there something else that you'd have to kind of do to position yourself?
Yeah, I think mostly when you have volatility that's running at this level, it's not like a meaningful influence on positioning or structuring, because you wouldn't want to build a portfolio on the belief that volatility on a forward-looking basis is going to be as low as it has been observed on a backward-looking basis, particularly over like the last 6 weeks. And so I think a lot of professional managers will sort of put a floor on their volatility assumptions as they think about position sizing and how much leverage they want to take. And that floor, on a VIX, let's say, looks like 18 or 20. They're not really going to assume that structurally you're going to get something that's meaningfully lower than that. And so like the difference between 12 and 14 and 16, it doesn't really influence what's going on. I think the real influence starts to come from a risk control process and a risk-taking assumption as you start to move more rapidly up, you move higher and more rapidly up. That's when it really starts to influence your position sizing and thinking about things.
Okay. I want to pivot back to the Fed. You seem to
pivot
have
to
an
the Fed's pivot.
Yeah, pivot to their pivot. And they just pivoted, the big pivot. I believe you hold the outlook that in this environment, it's likely to be high for longer. Is that correct?
Yeah, I think an environment like I think going and thinking about the Fed's policy and asking yourself like why ease, like genuinely, like why should the Fed meaningfully ease monetary policy? I could understand if growth was weak, right? Then it would make a lot of sense to ease or not tighten as much. Like back when we had the SVB situation, it made sense that they were a bit more cautious as we were sort of sorting out, is that going to be a big deal or a small deal? Ended up being not that big a deal, but it made sense for them to be cautious. But like, where is the thing that causes the Fed to be hesitant with the current monetary policy? Like, as far as I can tell, it's nowhere, right? And so that's the basic question when you think about like central banks' behavior is tilted towards stasis, right? They sit, they wait, they want to see more evidence come in, right? What have we learned over the course of the last 2 years is that the Fed's, 3 years, the Fed's always behind, right? Because they're sitting there, they want to be real sure that something's going to happen. And I think that's reflective of the fact that their natural position is to do nothing. And so now the question is, what causes them to move quickly? Central banks move quickly when growth conditions are rapidly deteriorating. They're actually quite good at that. When growth conditions are bad, they move, right? Particularly to the downside. But like moderation and inflation to a level that's slightly above their target, is that the reason why they're going to cut interest rates at 160 basis points? Like it genuinely it does. But when growth is okay, so what are they going to do? Like why would they ease interest rates aggressively other than they just wanted to like juice asset markets all get out, which is basically what they've done, even by the sheer hint that they might ease a little bit.
And that's what they've done since Greenspan, right? Is just constantly juicing the market with these lower rates. So who stands to lose and pay the price for this, for the fact that the Fed, or for your idea that the Fed has no catalyst to cut rates and that they'll be higher for longer? Who in your opinion is positioned to lose the most here?
I think it's got to be folks on the bondholders. People who are buying bonds today, and I thought today was actually a really interesting example because you saw this intermarket action dynamic that was happening, which is that stocks started to fall and bonds were bid hard in response to stocks falling, without much recognition, without an acknowledgement that like bond yields have already fallen a ton. Right, it's a 1% or 1.5% move in stocks just off of all-time highs, right, in a total return basis, is creating a huge bid on bonds. That set of linkages doesn't add up. I mean, it adds up directionally. Like in general, when stocks go down, bonds often go up. But what doesn't make sense is the magnitudes and the order of magnitudes between things. And so basically, we've got a situation priced in the bond market where huge cuts are expected, no inflation, and recession that's priced in. And it just, it feels a lot like conversations I was having, a year ago when I was like, look, the economy I think is going to be a little more resilient than people expect. And people were like, you're an idiot. Buy bonds, 3.5. They're going to 3. They're going to 2. People were hollering about how bonds were the best buy in the world a year ago, and they were dead wrong by a lot. And only, really bailed out here in the last minute by the Fed and Treasury easing. And so I think we're like getting back to that same situation. That's why I go back to that headline story, which is the macroeconomy itself is not moving. It is boring. It is meandering very, very slowly, moderating a little bit. And our expectations are going like this. And the expectations today in the bond market are for no inflation, fast interest rate cuts, and a terrible growth outcome in 2024. And it just doesn't make sense.
Have you seen this before, Bob?
I think we've been seeing
this kind of posture.
I think we've seen a lot of this over the last. We saw it after SVB, where how many people on FinTwit were sitting around saying SVB is the next, equating SVB to the financial crisis. Like, for those of you who might not have been through the financial crisis, I know there are a lot of people who aren't necessarily very close to it. I was very close. I led Bridgewater's research on, whether the financial crisis is a big deal or a small deal. And I said big, which is probably a good call. It was like working with the Fed and the Treasury, the White House about what was going on, and was deep into the bowels of it. Like, SVB was a joke relative to the financial crisis. The financial crisis, every bank in the world was broke 10 times over. And here, a couple of, VC bros could have lost some dough. Like, that's what we were talking about. That's the difference we were talking about. It doesn't mean that the policy wasn't necessarily a smart policy to ensure that there wasn't a broader bank run and it wasn't bigger than it needed to be. But it was not the financial crisis. But at that time, remember, interest rates on the short end were pricing in a 3.50 Fed funds rate for December 2023 in April of 2023. 3.50. What is the rate today? 5.50. It wasn't close. It was dead wrong in terms of what was happening, what ended up happening, because there was a total misjudgment by the market in terms of what the growth outcomes would be as a function of SVB. And that's, it seems very similar to me today, which is there's just all this initial, this sort of immediate sense that we're going to go back to zero interest rates. The Fed's going to cut a ton. All bonds and short rates are bid, and that's just how it's going to be. And then you talk to people on Twitter, you say, maybe, it's not going to be that way. And, people are scalding you for even suggesting that, there isn't going to be an immediate rush to, near zero interest rate policy. But we're in a different regime. The economy is much stronger than it was 5 years ago. Asset prices are a lot higher. Houses, stocks, balance sheets are much better repaired. People have termed out very low interest rate borrowing. Like, this economy is not the same economy as we saw in a zero interest rate policy world. And so the combination of that fact, which raises the neutral position, with the fact that the economy is operating in a way that's quite hot, you put those two things together, and a rush to very low interest rates seems very implausible at this point.
That makes a lot of sense. I think SVB was on the news for about 4 days, maybe. Let's pivot to oil. There are a lot of traders that speculate on oil. Lots of events took place this year that could impact oil, that caused it to run up into the 90s. Just a couple weeks ago, it was down at 68. It's been floating between 70 and 75 right now. We've had Ukraine, this Middle East conflict that started in October. We've had OPEC Plus kind of battling with each other with cuts and so on. How do you see the action in oil in the first half of 2024? I mean, they've done everything they can to bring it back to $80 and hasn't worked so well.
Yeah.
What's your view there? I don't know if it's something you analyze much, but I'd like to hear your opinion on it.
Yeah, I think oil is an interesting market. In many ways, you want to think about it sort of, it's almost two different markets that intersect with each other, which is it's a paper market in terms of, money, fast money speculators, and then it's a real market in terms of there are people, who consume oil and produce oil and things like that in the market. And so, and you sort of have to balance both of those things at any point in time. And the ideal moments are when those two pressures are sort of moving in the same direction against, a valuation that's in the opposite one. So when I think about that context in the real demand in the real market, the oil situation has been one that has been, there's a lot of supply. Like U.S. supply in particular is just, the U.S. just keeps hitting new highs in terms of supply, and most of what can be done is OPEC, and particularly Saudi Arabia, are just trying to take barrels off the market so we don't get a big price decline. And they've done a pretty good job of that, and they have a lot of flexibility. And I think that, that kind of makes sort of, let's call it the natural position in oil, like in the 80-ish range, right, which would keep up with the demand dynamics, which are going to be decent, with, the supply that's happening, a little bit of Saudi Arabia coming off the market. I think the real interesting thing is what's going on in the paper market, where we actually see hedge funds in particular and fast money really selling oil aggressively. I think it's one of those things where the intermarket action is driving things that are nonsensical, because what is happening from many of these funds is that they're seeing bond yields collapse. And what would, if you go back to the financial crisis, some people might not remember, like oil pressed well into the hundreds, right?
Yeah.
And well above $100 a barrel. And the financial crisis hit, and oil fell to, fell like 75% in the course of weeks. And so a lot of people equate the bond yield move with oil. There's an intermarket action dynamic that are trading those things off. And so I think what we're seeing is that that's causing a big paper short to emerge in the market, which is not really consistent with the underlying fundamentals. And so if we were to get pressure off the bond yield, I think we're probably going to get upward pressure on the oil market in the context of, a balanced market that is, I guess we're like a little bit below what the right price, we're still a little bit below what the right price is on a balanced market.
Got it. Okay. Is there crude and Brent are priced in dollars? Is there a currency, a dollar index component to that as well?
Not really, which I know will, which I know is counter to what a lot of people say in terms of whether the dollar influences oil. The dollar doesn't meaningfully influence oil. Like, just think about it. Oil's volatility is, 30% a year, standard deviation, and the dollar's volatility. I mean, first of all, we're 25% consumer of oil, or, a big consumer of oil. So, and we consume it in dollars. So the rest of the world, the dollar versus the rest of the world, like, has like a 7 to 10% volatility. And so the dollar can move 10%, and that would be, like $5 or $6 move in oil, which you'd hardly notice in the flow of days when it goes up 3% and down 3%. So it's just not the big thing. The big thing is the underlying supply and demand, and then the paper supply and demand for the market. And people get confused because they look at the dollar movements and they see oil prices go down when the dollar goes up, but that's not a function of the dollar. It's a function of a collapse in global growth, which causes dollars to rise and oil to fall at the same time. So they're mistaking those two linkages.
Got it. I was going to hit you up with a question about gold, but because that's been all over the place. But I'm going to let Landau here with Convergent relay some of the questions from the audience.
Oh, yeah, that's actually one of the questions. So Bob, there's two markets that some of the people in the chat are asking about. They want to know your opinion on gold as well as real estate.
Well, gold. Actually, I posted something on Twitter that was interesting earlier today about gold, which I think I'll figure out some way to post in the comments or something. But if you go to my Twitter, you can see it, which is, gold, the way you think about gold is it's non-interest bearing money, right? And so you'd expect gold to perform better when interest rates fall and worse when interest rates rise. But gold has been very resilient. And if you look through history, it pretty much trades that way on a marginal basis, like in a day-to-day sort of basis. But gold's been very resilient. We've had a 300 basis point rise in real yields, and gold is up, not down. And so why is that? Well, that's because structurally there's a very high bid from global central banks in particular that are using it as a defensive reserve asset because their fiat currency is getting stolen from them. So what's practically happening is the Chinese and the Russians, who are two of the biggest gold producing countries in the world, are actually just pulling all domestic mine supply off the market and taking it for themselves, plus buying more in addition. And so that's very interesting because they've created a very tight gold market and created a continued bid in the gold market at a time, when US interest rates are relatively elevated versus history. And I don't expect that to change. And if anything, we could easily see gold maintain or even do a bit better as a function of what's going on right now. As if we could start to get, retail demand has actually been negative, big selling out of ETFs and other retail demand. Even a normalization of that could create a real squeeze upward in the gold market on a tactical basis. So that's gold. Oh, the other thing is real estate. I don't have much of a view on real estate. It's not my area of expertise, and it's not really a macro asset in the sense of, I know that sounds kind of silly, but it's like, in general, it's not like a liquid macro asset. Obviously, housing influence and real estate influences the macro economy sort of in that direction. But the precise pricing of assets, I'm not like close enough to that market to have a particularly compelling view.
Let's just ask, would you buy a house at 7% today?
At 7% at all-time highs? I don't know. It certainly it looks better to buy a house at 6% than it does at 8%. That's what I'll say. And so it is one of those things that, look, housing, people got to move. It happens. 7% of the economy moves just because they got to move. They get married, they get divorced, they have kids, they go to college, they get a new job. It's just how the market works. And right now, the move rate is way below what it's been on a secular basis because of the high interest rates. And so I think what you're going to see is even the slightest bit of movement down is going to draw out the sort of shadow demand that's sitting around, which is going to drive prices higher. Prices are rising at 1% a month again in housing on a like-for-like basis. I mean, that is, all the homeowners, 65% of the market's feeling richer every day. The people who are going to pay the price are the poor millennial families that, are buying in right at the top here.
Yeah, I mean, it's a necessary expense. So very cool, Bob. I really appreciate. Landau, do we have anything else for Bob?
Another question is, when does he think bonds would recover to historical negative correlation to equities?
I think it's going to be when bonds and stocks are primarily driven by differences in growth expectations and how growth is evolving. They trade negative. When it's driven by how inflation's evolving, they trade positive, inflation and monetary policy. And so my guess is we're going to see that, the inflation side, the inflation volatility on a forward-looking basis in 24 is probably going to be a lot lower than it's been in previous periods. And so I think we're going to start to see that divergence between, stock and bond performance start to emerge really here in the first half of 24. So probably, soon. And actually today is a good example. Bonds got bid, stocks sold off. God, it felt like, normal.
Yeah. Cool. Is that it, Landau?
Yeah, that covers everything.
Very cool. Bob, we've dropped your links into the live chat. It's all in there. And of course, we invite everybody to go check out unlimitedetfs.com. Bob can be found online on Twitter. He tweets a lot. There's a lot to kind of go through when he does tweet. twitter.com/Bob E Unlimited, Unlimited on Twitter. He's also on YouTube. You can find him at I forget the YouTube.
Bobby Unlimited.
Yeah, at Bobby Unlimited. And of course, he's on LinkedIn. Those are the places you can learn more from Bob. I look forward to talking to you some more. I appreciate you taking time out of your evening to educate us a little bit and share some of your perspectives.
Awesome. Thanks so much for having me.
Thank you. Cheers. Okay, very cool. Let's move to the next segment, which is zero DTE. So let's bring on Jasper here. Jasper, if you want to flip on your camera, you're self-muted.
Yep. Hello.
There we go.
There we go.
Jasper, how are you? Thanks for talking to us
Great.
today.
Yeah, thank you for having me.
Very cool. So let's get into it here, Jasper. Let's talk about a little bit about, you know, what you do. How did you get into trading? Just give us a little bit of background here. We'll spend a few minutes on that.
Yeah, so I was always raised as like a buy and hold investor, you know, so I was very much a boglehead growing up. And then COVID happened, which I think is a common story, but you know, COVID hit, and then I came across Wall Street Bets, and I was seeing people punting options, you know, making these over leveraged returns. And then that's what first sucked me into the options market, or, you know, actively trading as opposed to just investing. But around this time, I had come across this tool code called Nope, and it was tracking net deltas traded in SPY to look for areas of reversion, essentially. At the same time, I was learning about gamma through squeeze metrics, and you know, he was talking about all the second order Greeks with respect to the options market. Now, at the same time I was doing this, some traders on Nope had introduced me to auction theory, volume profile, you know, so I was diving into Dalton, Stoudemire. I got really heavy into footprint, so I was watching like Brannigan's course on footprint. So that was sort of my primary framework for understanding active trading, right? But at the same time, I was reading all this math stuff about the options market, and it seemed like too useful to pass up on. And you know, I wanted to figure out a way of incorporating that to all of the, you know, volume profile style value trading, right?
Okay, that's a good rundown. So essentially, you're looking at the same markets in the same way as most of our audience. Let's ELI 5 this. Explain like I'm 5 years old again. What is zero DTE? What is Gex? What does Gexbot do?
Yeah, so with gamma, I have two explanations, right? So there's the textbook one that I'll go over, and then I'll have a more intuitive explanation. I think that will make more sense. And I think, you know, people who have traded zero-day options are probably intimately aware with the intuitive sense of gamma, right? So all gamma is just the second order rate of change in the value of a contract with respect to moves in the underlying. So what does this mean? Well, it's essentially just a measure of momentum. So for contracts that are close to spot price and close to expiration, that's where gamma is highest. That means it's the momentum factor of how these options are changing in value with respect to spot price is at its greatest. So an intuitive explanation is a metaphor that I like to use, is that it's sort of like driving your car to a doctor's appointment. And so the distance that you've traveled is the value of the contract. Delta is the speed with which you're going. And then gamma is how hard you're slamming on the gas. So it's how hard you're accelerating, right? A more accurate metaphor is that it's the market that's driving the car and you're in the passenger seat trying to manage your position as it gets whipsawed around, right? So when we're looking at gamma, or when I was, incorporating gamma into all the volume profile tools, it was really just a lens to look at the options market. So as you can imagine, when you first look at the options market, it's just a tremendous amount of data, right? Like, how do you compress this in a way that's actually useful and not just overwhelming in terms of, actual execution, right? And so, when we're using gamma to look at options market positioning, we're really looking at positions that are most affected by intraday moves. So the opposite might be, for further out contracts that have much more time to expiration, they have a very low amount of gamma. So there's very little momentum. It's similar to, a guy who is long in a retirement fund, doesn't care about what's happening on an intraday basis, right? So whether spot is, selling off on intraday, he's not going to be reacting to that movement. But on the other hand, for those positions that have high gamma, so they're the most sensitive to intraday moves, then we know that, their positions are being affected much the same as when we're watching the tape, when we're watching footprints. When we're looking for aggression on the tape, we're looking for a passive seller, and maybe his position is being threatened. And then so there are ways that people react to that. And gamma is essentially a way of translating the options market to a very similar lens we use when we're looking at order flow.
So two questions come into mind. How is gamma exposure impacting trading in something like the S&P 500? Like, what, how could I'm just going to show everyone a view of what Gexbot looks like. So this is, of course, after market. Let me share this screen here. So there isn't much action on here.
No.
So there's not going to be much on here to show.
Today is a pretty great day for those.
Yeah, but what this shows is it gives on the right, it gives where the zero gamma price is. And remember, these are spot prices. These are spot prices, not futures prices, right? So there's a difference between spot and future. There's a premium. And what this shows is how folks are potentially stacked one way or the other. So let's just say we're in the middle of the day trading. How are you monitoring your Gexbot app to make decisions while trading futures?
Yeah, so when positions are being put on an intraday basis, Gex is really helping us see what is the convexity that they're looking for, such that, if someone is looking for a move, say that they're long put. So today was actually a great example, although I think our tab or the site, you don't have access to it currently. But around like 1 p.m., we had a set of long puts that were coming in. And so they had an extreme amount of high put gamma on there. And so it's telling you that on a short time frame basis, someone is looking for a move. So they're looking for range expansion, so volatility to increase, right? So, those contracts, because they have such little time on them, they're pretty much, the value of those contracts are entirely dependent on actual intraday moves, as opposed to, say, volatility over a longer period of time. So, oftentimes you can think of a major point of Gex as being someone who's willing to short at this level, right? But at the same time, they can often form these reversion points. So there's a classic look on Gexbot where, on range days, typically, on our options profile. Yeah.
Let me ask you this. Would it help if I just gave you the screen to show us what you're talking about?
Yeah, I think that might help.
Here, let's shoot you over and make you presenter. You're going to get a little panel that asks you what screen you want to show. Just make sure there isn't anything sensitive on that screen before you decide to show it. Great.
visible? Yes. Okay. Okay, so here's an example. So for context, the prior day, so this is on December 15th. This is actually last Friday. This was OPEX. Now coming into this day, SPX for the past few months has been grinding up, but then we had this intraday sell-off on the Thursday prior. And so on the open on this day, we actually saw a number of long puts that came in. So essentially, the idea being here that we had auctioned up, we had V reversals, EOD the prior day, overnight had stayed around the same area, and then someone was expecting us to continue this sell-off. So they had stacked a whole number of long puts, and let me actually explain what I'm showing here. So on the left side, we have our options profile, and then on the right side is the Gex of those positions. So here, the purple bars are puts, the orange bars are calls, and then when bars are extending to the right, we know that these are bought puts, and when options are extending to the left, we know that they are sold contracts. So here we see a number of sold calls all the way up, and then down here we actually have a number of long puts. And then here we can actually see the convexity of these positions, the gamma, or the momentum of them, right? Now in this case, these positions were opened on in the morning, but they were unable to monetize, and we actually ended up just ranging around this area above them. And then as we were going into the afternoon, we started getting a brief sell-off, but it failed to fully follow through. And so this is it's very similar to an order flow, right? When we were thinking about who's in control, are buyers in control, are sellers in control? What happens when that control shifts? What happens when one side loses control and it slips? And so, in this case, when I'm looking for, because it's Friday, because it's OPEX, as we're heading into EOD, these positions were still waiting there, but they failed to monetize. And usually on Fridays, you can get a bit of a volatility expansion where, if something slips, then you can get a very convex move. And that's sort of what we can see here. So sellers unable to push through, to follow through. Then we start bounding around this short position of these long puts. We test the top set of puts, bounce off, make a higher low, and then everything flies in their face, and then we squeeze up. And at this point, we had major positive marks at 47.25. All that is marking a peak of upside convexity. So we can think of, if buyers are looking for a move, what's the optimum point if you're an option holder to either exit or take profit on a position. And that's where we end up hitting and bouncing off.
Is that at the 47.15? Is that what it looks like? It pulled back there. I see a little.
Yeah.
It's like at the close, it seemed to have pulled back right to that. That divider.
We had slammed up into this peak of call gamma, and then we had buyer exhaustion, and then we ended up falling right back to. And what's funny is with these positions, SPX actually closed just above these puts, I think literally by 2 cents, and the puts expired out of the money. And so the nature of these, I know, right? That's kind of how the market works, right? Screw everyone. But the nature of these positions too is that because we know that they're on the book, they often act like resting limit orders on the LOB. So for example, if you're watching something like Bookmap, right, oftentimes you'll see orders that are coming in, limit orders, and then price tends to draw or be sucked towards it. Essentially, it's the auction process that's looking for liquidity, right? It's not about whether price is going up or down. It's about trying to find areas where buyers and sellers can agree on a price. And a very similar effect goes on with these positions too. The difference being that when these positions are put on, we know that there's actual risk being put on, as opposed to the LOB where it's, maybe someone's flashing a limit order and maybe it's real, maybe it's not. Sometimes it's hard to say, right?
Okay, so when you have like a major positive line, essentially, these puts and calls are being bought by folks who have a long or short bias on the market or who are defending a position. I have a huge amount of longs in the equity market, and I'm just gonna, as often as I can, going to buy insurance by buying puts, so that if the market crashes, I lose money on my stocks, but then that's protected by my puts, which have an expiration date. But there's the character that we don't hear too much about, which is the market maker or the person who sold that call, and that person is collecting premium, and that's as good as it gets for them, and they have unlimited risks. So when the market pushes through a call strike that has a lot of volume at it, there are people there that are going to have to cover that position by either buying the future or buying the call back or something. So you get these, and this is the importance, like part of the importance of this is that you want to know what's happening close to at the money where delta is changing quickly. And I know we're talking options here and many folks don't understand options. I challenge you to go read about options. They're just an incredible market. But as the delta moves, the rate at which it moves is what gamma describes. It's the rate of change of that delta. So gamma becomes really strong as the market gets close to being in the money. And so what that does is it forces those market makers or the people who are short to do something about their position. Otherwise, they have, if you're short a call, you have the obligation to deliver a long position on expiration, and your risk is unlimited unless you have a spread on. So this is, how does this impact us? Why do we care about this as futures traders? Most of you will recognize that there are instances of the market where it just makes no sense that somebody's like coming in and just like lifting 1,500 and sweeping the book or whatever. And these kinds of moves can be explained by this type of action. Would you agree with that assessment, Jasper, or am I misunderstanding it?
To a degree, yes, I would agree. So when we're looking at like volume profile, right, we have a historical context of where our levels are. So where was volume or where was value distributed, right? But then when the market opens, we're watching the tape. Our view of where price is restricted to spot price, right? But that's not where participants are looking beyond that at all times. They're looking at distributions of outcomes, and so looking at these levels allows us to have a bird's eye view of what people are expecting in terms of volatility or price. Now I do want to say, with market makers, I think that they get a bit of a boogeyman status, right? Their goal really is just to collect a spread. They're there to facilitate buying and selling. And in fact, their presence in the market is actually it's a good thing. It actually makes markets more robust, right? So an example might be, during something like FOMC minutes where liquidity dries up on the book and there's no one there willing to take the other side of a trade, that's when you see volatility kind of spike, right? If you're watching ES and it's moving around erratically, it's because there's no one there to facilitate that auction process. But that's sort of the role of the market maker, is to facilitate that process.
Yeah, and then short-term traders help that process out by taking the risk of being there to take advantage of the spread. That's what scalpers do in whatever time frame. Do you know, just to give us an idea of how this has kind of exploded, do you have any stats? Do you know what the volume has been on like 0 DTE type trading recently?
Yeah, so it's grown exponentially. I think it's another one of those boogeyman type situations, though, where there's this idea of retail speculating with the 0-day options, mostly because they're very, very cheap and they allow a lot of leverage, right? So you can buy a couple, a decent amount and make an outsized return. But in reality, for the most part, most of the volume is really from farming yield, so selling options, whether that's institutions or retail in general. Most of the 0 DTE volume has been in shorting vol, right? Now, the effect of this has actually been a stabilizing effect on a market. So you imagine if everyone is shorting a number of puts below spot price, and then everyone's shorting a number of calls above spot price, then their contracting range, or there's an expression of range reducing and reducing volatility. So there's a stabilizing effect to this. The risk, though, is that if in the event where everyone is maybe crowding the short vol trade, right, and news hits, and there is potential for intraday systemic risk of all of these positions being flushed through, right? So if you're short a put, the convexity of your risk is all to the downside. So if your position is being threatened and you get run over, it has a compounding effect where everyone is forced to either buy back their puts or protect themselves by shorting in ES, and this has this magnifying effect on the underlying, or it can have that.
Yeah, there's a tremendous. I read recently that the volume in 0 DTE options, these 0 DTE are just options that are being bought or sold on the day of expiration. I heard it's on the SPY, the option volume for 0 DTE has gone up 175% this year. And a lot of that, there's always the other side, but a lot of that are folks who just don't want to put up the money to trade the SPY, and they just, a lot of it is folks catching flyers. I'll buy a call for 20 cents, the thing rips up, it goes in the money, and I made $6, on 20 cents, and I don't have to have a stop because, it's a call option. You don't need a stop. It just expires worthless. I lost 20 cents.
Yeah.
So this is quite tremendous, and what it does is it reflects itself across multiple markets because all the markets are organically connected. It's reflected in the SPX, it's reflected therefore in the ES, and we're seeing more and more 0-day to expiration options being traded in things like crude. I get information from the CME that they're seeing just an exploding amount of trading that goes on. So a tool like Gexbot exposes that for particular products, for the SPX, where there's the information that you can collect and present in this way. Gexbot doesn't do this for something like gold or crude or anything like that, right? It does it for very specific index products, right?
Yeah, so this had really started as a tool to help for trading ES. That was really a primary focus, and so it had started on just looking at SPX. But we have started adding other tickers, and I know that they had added 0-day options for a few other tickers recently. But we do want to add more to look at that, because something like Gamma or Gex is not restricted to the instruments. For any sort of positioning that is constrained by time, right? There's an expected target date. Gamma factors into this as well, regardless of what the asset is. Same for all the other Greeks like Bana and Charm, right? When we're looking at the nature of these positions and how they're changing over time, that's where the Greeks can kind of give us that window into that positioning.
Right. Okay, cool. Let me, so we went through an example. One last thing, we did ask you for something to provide to listeners today. And what you did provide is a 20% discount to check out Gexbot. I believe that runs till the end of January. I certainly recommend that folks check it out, especially if you have an understanding of how options work and so on. Somebody had asked if you have a chat room to accompany the tool or some way to understand the tool in real time. Do you offer a service like that or no?
Yeah, so we're on Discord every day, and we're generally available to answer questions, whether it's more practical or more theoretical too. I think I can post that in chat, or we can release it later.
What we'll do, in addition to put it in the chat, if you give us the links, we'll put that in the video description as well, so anybody watching after the fact can find that in the description.
Do we have any questions for Jasper?
We had a question from Eric. I didn't quite understand the question, so Eric, maybe if you can clarify the question. He's saying that if more positive Gex versus negative Gex, et cetera, explain, and then he says magnet, et cetera, if you can. So I'm not sure if that was specifically related to something in real time that we were discussing.
Maybe he's asking about like maybe the draw of liquidity. Oftentimes, because when we're marking these peaks of convexity, there's a very similar dynamic where, because so many eyes are on this level, or people are positioned around this level, we tend to then get pulled towards them. And so there's a magnifying or gravitational effect that occurs.
You explained it well earlier that the market seeks liquidity, which is something I heard when I first started trading. I used to hear these big traders go, reminding us, hey, the market is seeking liquidity, which made no sense to me. But then I stopped scalping for ticks and started trading the auction, and it just made total sense that you see liquidity sitting up there, and the market will generally will fill orders more efficiently by going to that liquidity if it's aggressive enough about getting filled, or the liquidity might come and meet the market where it's at. So having the layer of looking at, okay, what's this exploding volume in options, how is that impacting how the S&P is trading, is basically what your focus and approach is, which isn't mine. This is something that I'm getting into now, but I've never considered the effect of options and option exposure, gamma exposure by big traders and market makers on how that impacts the S&P, and this is what this conversation is about.
Yeah, I think someone had mentioned to me like an interesting way of thinking about the auction is that it's not really about whether we're going up or down. Like that's not really what the auction process is, right? Because if you think about it, whenever we're moving up and down, yes, we're buying, and so spot price is moving up. But at the same time, people are also selling into that, right? Like we're not. It's a two-way process. And so when you're thinking about the auction, it can help to think less about whether we're going up or down, but rather, the auction is trying to facilitate, buyers and sellers. It's primarily for facilitating transactions and not for people who are speculating, really. That is the real underlying driver for how the auction works.
Very cool. Excellent.
Cool. There's one more question.
Mm.
And actually, before we hit that question, Morad, you didn't mention the code itself. So the Gexbot discount code that Jasper is running is Fireside 20 for 20% off from now through January 31st. So if you guys want to take advantage of that, go to gexbot.com, and during checkout, the code should be Fireside 20. And that'll be in the description as well. Last question here. The Gex Classic shows dealer, market maker, gamma exposure, right? That was a question. And then he says, so when I see major positive Gex strike, that means participants are selling calls at that strike and dealers are buying calls.
Yeah, that's really a good question. So Classic is using so there's the naive assumption really that for SPX, all options volume is for hedging purposes, right? So we're assuming that the customer is long the put and short the call. A prime example being that of like the JPM caller, right? And so if the customer is long the put, that means that the dealer is short the put, and then vice versa for the call. And that's why all the calls are considered positive gamma. And then for all the puts, all the dealers they have negative gamma exposure, right? Of course, it's a little bit different in state. In state, we're actually viewing it from pay-per-view or customer view instead, just because it's a little bit easier to orient in terms of, when we're thinking of like order flow, or when we're thinking of participants trying to express a view, it's a little bit easier to understand that in terms of their direction, as opposed to, dealers are taking the other side. And okay, so they have these hedging requirements, but they're actually, counter to the original participants' purpose with opening that position. So that's why it's a little bit different between those two tabs.
Anything else, Lendo?
One last thing he's asking, can Gexbot be used for all stock options, or only for SPY?
That's a really good question too. So originally it started for trading ES, right? So it was just about the ES SPX relationship. But in reality, for something like Gex, I would say the most alpha is actually in really illiquid equities, illiquid single name equities. So if you think about it, right? So stocks or option chains that have poor liquidity, they're very susceptible to volatile moves. Those volatile moves, which you can measure with gamma. So if you're looking for, some hated stock that's, been short constantly by most participants, those ones are the most vulnerable to squeezes, and Gexbot can actually find those out. But that's kind of a longer term.
AMC comes to mind.
Yeah,
And
GameStop.
GameStop.
Yeah. I didn't want to say the name, but yeah.
So one thing I want to point out is, as you probably noticed, Jasper speaking at a different level, and we only had about a half hour to scratch the surface here. There's a lot underneath this. And I would definitely suggest checking out what Jasper's doing. I came across Jasper as from a relationship with one of the guys at EdgeClear, and we met, and I looked at Gexbot and I was like, what the heck is this thing? But it's been very interesting watching the videos and seeing how it works, because I'm not, I haven't spent enough time on it, but I see a very, with my understanding of options, I see a very, very strong potential for using it as a support system for what we do, which is profile trading and things like that. So it's something I definitely would suggest you check out. Of course, that's up to you. I'm not trying to shill anything at you, but there is a lot of information there that can be extracted from the tool. Jasper, I want to thank you for coming in. We've dropped the information about Gexbot. Again, you can go to gexbot.com. If you want to check any of the packages out, just the coupon code is Fireside 20, and that gives you 20% off to check it out. It's worth the investment. You know, try it out for a month or whatever, and I think you could probably pick up a lot from that exploration. Thanks for coming on, Jasper. I appreciate you being on camera with us today and sharing some of your knowledge on this, and we hope to talk to you soon.
Thank you, Murad. It's always a pleasure.
Cheers. Take it easy.
Bye.
All right, so moving on to my favorite coach, Jared. Jared, do you want to join us?
Of course. Ryan, how are you, man? Good to see you.
Hey, Jared, thanks for coming on. For those of you who would be, I'd be shocked if you have not heard of or don't know of Jared at this point. Jared, why don't you give us a quick rundown of who you are, what you do, and so on?
Yeah, I guess I'll go backwards first. So for the last decade, I've been coaching traders, poker players, esport athletes, of course, golfers as well. I say the last decade, but that's really when trading kind of began. I've been coaching for the last 18 years. I am a licensed therapist. Spent 2 years getting my master's degree, subsequently getting licensed, but I've never actually practiced. As soon as I got my license, I quit my job and started working with golfers out in Arizona in 2005, and I've been developing my program ever since. And I think what distinguishes me in the field is that my system that I have developed, kind of originated in golf, honed in poker, and brought, and I'd say kind of weaponized in trading, really establishes a framework with which we can kind of talk about anger and greed and confidence issues and fear in very kind of practical terms and solve a lot of the main problems, mentally and emotionally that traders experience without kind of getting too esoteric and kind of out there. So it's really a systematic framework to address those problems.
Very cool. Recently, you've been working on something called the Mental Game of Trading Live. Can you give us just a quick recap of, I'm much more interested in why you felt this was needed. I'm interested in what it is, but also address why you felt this is something that you needed to put out there for traders.
So Mental Game of Trading Live is a closed platform. This is not a Discord group on purpose. I don't want a lot of noise on a day-to-day basis and an intraday basis. I want to have a place where traders can kind of come and get support from the mental emotional side of the trading, right? Trading psychology. And really, in a way, you're kind of hiring me to be part of your team. A lot of traders work independently and they're isolated. They don't have the opportunities that a lot of institutional traders get. So if you're going to compete with them, you need to have somebody like me kind of on your team. And so becoming a member of the platform allows you to do that. And one of my main drivers for doing that, truthfully, on a personal level, professional level, was I was just getting a little tired of one-on-one work. I wanted to kind of branch out and have more of kind of a group interaction. And what's been great is that it actually has helped me learn more because I'm now at a lower price point, able to bring people in on a one-on-one basis that I wouldn't normally be working with. So it's almost kind of like individual coaching in a group environment where I'm working kind of individually with a lot of the traders on the platform. There are 2 different tiers of membership kind of offering different degrees of access to me, but I'm working with everybody and providing feedback on their worksheets and answering questions and, really helping them to develop their own, mental game strategy to addressing the main problems that they're facing. And so, yeah, I've been able to kind of experience a lot of kind of new interactions and, learn more about kind of what different traders are dealing with. And again, the framework all works. It just is a bit more interesting for me. And I think, for the traders, it's basically providing like a low cost option to have somebody like me, easily accessible on a daily, weekly time frame. And the way I've kind of structured it is, there's these weekly strategy sessions where you can kind of come on and and have your questions answered and provide feedback. But I think the main value proposition I would say is that you don't really know kind of when problems are going to strike, but you want to be able to have access and answers very quickly, because the market just moves too fast and there's just too many opportunities that you don't want to miss out on, especially as you look over a larger time frame. So to be able to just kind of quickly just kind of jump in and be able to get feedback immediately. And I've been able to kind of see that, where there's sort of this ebb and flow where kind of people come and go and they get what they need and then go work on their own, and they come back and get a little tune up, so to speak, or there is a bigger setback and they're kind of struggling with something that they hadn't yet anticipated. So it's really just kind of having a place where you can always know that you can get help. But again, not like a Discord group where it's, again, a lot of kind of intraday noise. We're not, there's nothing about, trade signals or individual trades. It's all about, kind of having a place where you can get answers. And frankly, there is a big database of kind of pre-recorded answers and feedback. So if you don't necessarily, want to wait for me to respond, which sometimes, can take a couple hours to a day, you can get answers even faster than that.
So essentially, for those of you who have heard of Brett Steenbarger, he used to work for Kingstree, a huge prop shop here in Chicago, and that's the service he offered. But what you're doing is you're creating that online for anybody to have, where you have a licensed person, a licensed trained person to reach out to when you're running into issues with, hey, I took a bad hit, now I just can't hold on to any trades or whatever it is, and not necessarily having you to themselves individually, because there's a library of videos that supports that. I feel like this is something that's been needed. There's one huge drawback about what you're doing, and you're basically playing the role of Wendy Rhodes from Billions, but you're not as hot as she is, so I'm not.
Thanks, Murat. I appreciate that.
Cool. Let's get into the subject matter for today, and it's that, as a performance coach, you feel that it's important for traders to review and take stock or take account of 2023 and take the time to set goals for 2024. Why is this exercise useful? Why should traders look at what they did in 2023 and, study it and take the time to do that?
Well, maybe we should say, like, all right, well, what's the purpose of even goal setting? And I think the purpose is that it sets direction, it sets trajectory, it defines your focus, it helps to frame your discipline. A lot of traders complain about being undisciplined, but you only need to be disciplined enough to achieve your goals. And if you're not achieving your goals, then we want to first kind of look at how well you are actually focused and adhering to a process that we would define as being disciplined. So if you don't have very clearly articulated goals, determining whether or not you are being disciplined or not gets a little fuzzy. So it's important to set goals for that reason. It's important to set goals because it actually helps to drive your focus. It helps to reduce some of the day-to-day decision making that you have to make. We all know from a decision-making standpoint that fatigue is a real thing. And as you start to stack the number of decisions you're making intraday with the decisions you need to make about kind of what you're trying to accomplish as a trader, it just gets easier. You're offloading some of that responsibility. You want to be able to wake up and know exactly kind of where you're pointed. And for many of you, it feels obvious because you just want to make more money, but it should be broader than that. So, kind of taking a step back now to answer your question, I think it's important to reflect on what you did this year, because reflecting is kind of how you start to then project, right? So it's take stock of what you did this year, how much you learned, where were the areas that you grew, skills, accomplishments that were, acquired in this time. Where did you fall short? A lot of times you may not have, let's assume that you set goals in 2023. How'd you do relative to what you set out to do? If you massively overachieved, well, then maybe you were setting your sights too low. If you massively underachieved, then obviously the opposite is true. But the point is that like kind of having that point of reflection gives you a sense, gives you a chance to measure how you did relative to what you set out. And I feel like sometimes traders are just, constantly, only looking forward. They're focused only on how much money they're trying to make. They're not always as focused on the skill acquisition, whether it be technically, mentally, from a process standpoint, from a research standpoint, from adding different dimension they're trading, maybe taking on different styles of trading, right? It's sort of constantly happening, but it's all kind of weaponized towards results. And I think it's important to actually start to define and consolidate in a way what you have acquired this year. It is kind of like a stock chart, right? If you went parabolic this year, well, you need areas of support in order to continue that trend, right? And that support comes through an internalization of what you've actually acquired that is solid. Otherwise, that parabolic move is going to fall off. And let's even say you've struggled this year. Well, there might be a lot of growth in that. Maybe you became a lot more resilient. You became a lot more resourceful. And so while you didn't necessarily get paid off, and it feels like the year was maybe lost or a bit of a waste, there were actually a lot of positive signs, right? There's kind of health in the market that is that's showing that 2024 could show upward growth. So having that can kind of change your perspective and oftentimes stabilize confidence, have your motivation be a little bit more, a little stronger day to day. And I think that's important for longevity. It's important for avoiding burnout. It's important. I mean, trading is incredibly stressful, right? And the amount of energy that's being burned intraday is high. This is not a normal 9-to-5 job. You're an athlete who is there, 5 days a week, in upwards of 10 hours a day with the high demands for output. And if you don't have very well structured goals, you don't have motivation and confidence to support all that, which can be taken away from by not actually going through that review and that consolidation phase, looking back on the year, then it's going to be a lot easier for you to burn out, to underperform, and to kind of just go through these more ups and downs throughout the year. Now, those ups and downs could happen from a P&L standpoint, but what about your own performance? What about your own execution? That's where you have a far more control, and doing the reflection that I'm talking about can help to really stabilize that a lot.
Okay, thanks Brian and John for joining us. Brian and John are convergence mavens. They comment on the markets all day, and also they run the group mentoring sessions with me, and they're exposed to a lot of these issues that you're talking about. So I wanted to have them come on in case they wanted to ask or comment. Goal setting for next year. What are the recommended ways to go about doing that and be effective at it?
So some traders kind of fall into one or two camps. They overestimate the importance of result-oriented goals, P&L goals, profit goals, or they say, well, no, I don't want to have anything to do with that, because when I do, it creates a lot of emotional volatility because they're not really goals, they're kind of expectations. So they end up being too process oriented and lose a little bit of sight of kind of what they're kind of moving towards. To me, those two, they fit together very neatly, right? Results determine the process that's required to achieve those results. And so, yeah, I want to see like kind of top line, what do you want to achieve from a P&L standpoint this year, or from some metric standpoint, whether it may be win rate or other measurements that you're using on a weekly, monthly time frame to determine how well you're actually performing or doing. I shouldn't say performing. How well you're actually doing. And it's okay to have like a range of outcomes in that regard, right? To set kind of the big hairy goals. This was an amazing year. This is what I want to achieve. Set the low goal, right? All right, well, this is kind of the minimum that I want to achieve or would feel reasonable if there was a ton of bad variance for me this year. If, I got derailed by some kind of personal illness or something happened where I wasn't able to trade as much as I wanted to. And then you kind of set like the reasonable target. And the reason we're doing this is because, well, why not shoot for the moon? But then if things go really wrong, you always want to still have something that you're aiming at without having to kind of recalibrate it on the fly. So that's kind of the first outcome, is like define the outcomes you want. And you can say that there's a more of a qualitative result goal that you want. Like I want to have my, pre-session warm up systematized so well that I feel like every day I'm starting the trading session with a very clear mind, like great energy, there's no residual emotion. And so, the outcome of that is, or sorry, the result goal is just having that. Like I want to have a well-structured routine that I can rely on day in and day out that I don't have to think about. I can just wake up and do. Okay? Or I want to have some outcomes with regards to confidence or, like the absence of tilt or the absence of greed or fear. But once you define those, it's important that you also articulate the why behind those goals. Right? Why do those things matter to you? And if it's from a profit standpoint, a P&L standpoint, it could be, related to your aspirations as a trader. It could be related to like how the money is going to be used and the utility in your personal life. Doesn't matter. But defining that why is really critical because you are going to be tested this year. There will be tough times. And it's that why that is going to help you to stay the course and not get derailed. And I kind of liken it to, an athlete, right? And I actually remember very clearly watching Rafa Nadal, I forget if it was actually Wimbledon or what stage in Wimbledon it was, but it was certainly, a later stage match. And, just watching him down like 5-3 in the final set, it just looked like he was digging deep, right? And that's a reference that we use in athletics very often. And like, what happens when you're digging deep? You're connecting with the why you care so much and what drives you and focuses you. And if you define it ahead of time, then you don't have to dig it out of your memory. You can actually use it on a day-to-day basis to ensure that you're going to have high energy, high focus, high motivation on a regular basis. So that's kind of the first two pieces. And then the third piece is defining the process goals and ultimately the how. What are you going to do on a day-to-day basis? I don't want you focused on those top line result goals on an intraday daily basis, but you need to have very clear objectives on a daily basis, the tasks, the what you're going to do that you have firm control of. Now, I'm not saying that you have control of it now, especially if there are skills that you're trying to acquire, but you ultimately have more control of those than you do, your medium or longer term result or your shorter term results. So what it does is it helps to make sure that you're not getting distracted by the ups and downs of your P&L, the ups and downs of the market, or the ups and downs of your performance, that you are staying the course and ensuring that you're working hard and working on the right things on a daily basis. And so those process goals become the third piece. And then the last one is taking time to think about the main reasons why all the things you just described can go to hell. Like what can be the reliable problems that are going to derail you? Might it be, a significant drawdown, significant changes in the market? Sometimes it might be, a fight with spouse or, something going on, on a personal level. And you begin to actually develop a small plan for how you're going to deal with those potential problems. And doing this does two things. One, obviously, if any of them happen, then you've got something immediately you can put into play. But I think more practically, the random things that could derail you become less likely to, because you're already looking out for the problems on the horizon. So many traders go into a new year with this kind of fresh mentality, almost like today's a new day. Well, today, now it's a new year. The calendar has turned, and there's a sense of just natural optimism. And I'm not saying be pessimistic. I'm saying make sure that you're always kind of looking on the horizon for the potential problems that can derail you. Because if you are, then you're going to see them coming. And if it is something that you haven't planned for, you already kind of have a mechanism in place for, addressing them because you've kind of worked through that already. So those are kind of the four big pieces that I work on with clients and certainly on the Mental Game Trading Live to get traders ready to have a great year.
So it's not too dissimilar to 2024 is when I'm going to lose 40 pounds, but not really figuring out how to work that a problem backwards from, what are the steps I need to take on a day-to-day basis to get there. is my kid's birthday party and that delicious cake going to derail that? And if it does, what's my plan for getting back on track? Those are some of the things. Just so that it's clear, could you explain the 4 points, but also explained why and so on. Could you just give us the headline points that you provided for setting goals?
For each of those 4 points?
For the 4, what are the 4 points?
Okay. So it's setting your result goals. It's setting and determining the why you care so deeply about achieving those things. Then it's the process goals, or the how, the what you're going to do on a daily basis to achieve that top line result goal. And then lastly, you're going to identify the problems most likely to derail you and have a small plan that in place to defend against them. Yeah, I mean, there's a reason why New Year's resolutions fail, and it's because the optimism is not matched with an understanding of what is going to trip you up. I mean, there are problems, lurking that the turn of the calendar is not going to delete. You can't just chop them out of your range, right? You can't chop them out of their potential to affect you because it's now 2024. So you may be able to escape their potential in the short term because of your inspiration, because of your enthusiasm and your optimism of what this year is going to bring. But eventually gravity is going to bring you back down to earth, and those problems are going to reemerge, right? There's no escape velocity here, right? The only true escape is the transformation and the actual correction of those. One of the things that becomes problematic from a goal setting standpoint is, and this is why this process is so important, because in doing it, you'll find yourself kind of being a little bit conflicted at times about what you actually want to focus on. And sometimes it reveals these kind of underlying flaws. For example, wanting to make easy money, expecting to make money every day, right? These are things that traders wouldn't necessarily say verbally, admit to, and yet here they are lurking. And so when you have, a very difficult time dealing with a January that wasn't exactly what you had envisioned, right? It's going to start to reveal the BS in the back of your mind that's saying, I should be making, 8.5% of my yearly goal in January. Right? So like it's as if it's going to play out perfectly that month, or I want to be ahead of that trend. Like we know intellectually that that's not how trading works, and yet subconsciously these flaws will emerge, and that's what's going to take us down. So this process is really important to kind of tease some of that stuff out so that you understand what you're battling against, and not just kind of relying on the inspiration of the moment to drive you throughout the year, because it's not going to.
So I asked a question in live chat, saying, please type in what you believe would be your top 3 goals for 2024. Of course, you'd want to take Jared's advice here and make sure you set those goals and have an idea of why they're important to you, what the process would be to achieve them, so they're not some high flying like, hey, I'm going to turn my $1,500 account into $150,000 a year, and then finally identify how this problems may come up that would derail this process. Let's say I've set realistic goals, achievable goals, maybe even stretch goals, and January wasn't so great, but not so bad. Then the first week of February, I just completely crapped out. Do I go and revise my goals, or how do I recover from something like this?
Yeah, I mean, at that point, it's just revealing. Your goals, if you set them for the year, you have a lot of time, right? We don't often know what we're going to face on the road to getting to what we want. And that's what makes this complicated. But, if you give up too quickly, right, and start to kind of revise it, it's like it hasn't, what you want hasn't changed. It's just your expectations of how you are going to get it were not in line with the reality. And so it's an opportunity to take a step back and do some, more digging and understand what those problems are and actually solve them. I mean, when you set goals, you think you know what's going to be required to get there. And then, trading has other plans. So it's just easy. And I'm looking at some of the goals that were listed here, and I realize it's a chat, right? There's not a ton of room to put details there. But the examples of wait for trades, don't look for them, be patient, go for singles or doubles. Those are great directional goals. But the real question that I have for you is, what is it really going to take to be able to do that? Because if you haven't been able to do that yet, that suggests there's like that internal battle, right? There's the impatience, there's the desire for home runs, there's the tendency to manufacture and manipulate trades. And so if you don't really understand why your mind is naturally doing that, well, then you're going to have to rely on inspiration to put you into an A-game state where those problems aren't really going to emerge. It's only going to start to happen, as you maybe have a little bit of a drawdown or experience a little bit of fatigue, have a bit more of a challenge when they're going to show up. And when they do, well, then you're going to be like, well, that sucks. But you wanting those things haven't changed. It's just that you haven't quite understood what's driving the impatience. What's driving the desire for those home runs, and all those things I talk about in the book. But sometimes the problem solving tends to be a little bit short. It feels easy to want those things because you know it's possible. There's probably been times where you've been able to do it well. The question is like, can you make that your new normal? There's a great quote from Nick Saban, the Alabama football coach, who said, we don't practice to get it right, we practice so we can't get it wrong. And so, just because you can do it in small samples doesn't mean that you've kind of created mastery there. And that actually is, another example of an outcome result goal. I want to have mastery over certain elements of my execution. That's a very defined result. And, your process goal could be, I don't fully understand why I'm making all these mistakes, but in 2024, I'm going to understand why, and I'm going to solve these SOBs and get on the right side of it.
Can you give me an example of, I've never had a trading coach, kind of had to figure it out myself. And my trading coach, to be honest, if I'm really honest, my trading coaches were the first 4 or 6 people I backed, people that I'm supposed to teach while they traded on my company account. And the reason they became coaches is because I couldn't get away from that thing we do where we're just, I'm just not going to think about it. I had to explain why I did the thing that I said they shouldn't do while they're watching me trade. So I had to really break things down and start from the bottom. But not everybody here is going to go out and back people and start a prop firm and things like that and get that opportunity. So if I have an issue where, I set these process-oriented goals, I believe I figured out the how and the why, but, I find my face in the dirt, a couple days into the year, and I come to Jared and I say, Jared, here's what's happened, help me. What are some of the things you do in order to help a trader with that sort of a problem?
I mean, the first thing we got to understand is like, what are the situations where it's getting triggered? Like, it's not happening at all times. It's happening under certain circumstances. Then we're going to understand more details of what's going on in your mind at those moments or before, and kind of digging those details out sometimes requires a little bit of data collection, on a daily basis. So a lot of times I have, well, certainly from a new client standpoint, my one-on-one work, I'm having clients fill out a very detailed questionnaire with, traders within the platform, Mental Game Trading Live. Right, I'm asking them those questions, like provide context of what's going on in your mind, what are the emotions at play, what are the actions, How would you describe how your decision-making process changes or your perception of the market changes? All of that becomes kind of like the puzzle pieces as we put together the clues of what is happening, because you can't understand causality until you have a full picture of what's going on. And so then once we do, we're going to start to ask those why questions, like, why is it that having a position get stopped out by a single tick and then racing to your target triggers anger for you, right? And for some, maybe it's a sense of injustice. Maybe it's just the raw hatred of losing in such a vicious way because I was right and the market didn't reward me. And so there's some expectations that are baked into that. So asking those why questions starts to kind of peel the onion a little bit. And we start to understand that the underlying flaws and biases and wishes and illusions and hopes that oftentimes we bring into the market, right? And that's what we're trying to clear out and clean out, because a lot of the emotional volatility that's occurring are those flaws reacting with kind of what's happening in the market, our response to what's happening in the market. And then that triggers a cascade of additional problems. So now here that position got closed out because I expected it to win or expected to be part of it. And then, well, now out of my hatred of losing, I'm now going to force another position to kind of prove that I'm right. And then that one loses. And then a bit of revenge trading comes in as we now sort of scale up and so there's a cascade of problems that can kind of happen afterwards. But even within those, there's still underlying causality, right? Sometimes we get into a little bit of a, confidence equals P&L. And so when we're losing, we lose confidence as well. And so we are looking for a winning trade to make us feel better. Again, I'm not saying that that's right. I'm just saying that that's what's happening. So to answer your question, it's really trying to dissect and analyze what's happening at a deeper level, because that's ultimately what we're trying to correct. We're trying to break apart those underlying flaws, biases, wishes, et cetera. Because once you start correcting at that level, then your reactions can start to change, right? The triggers don't go away. Those landmines are everywhere. But the reactivity in you needs to start to get cleaned out, so you're not as reactive to what's happening.
Very cool. Landau, I'm going to go to you and see if there are any questions that we have not answered.
Yeah, we have a question. It's about not being influenced and trusting yourself. So the question's, how do you not follow someone, a YouTuber, a trader who suggests market direction and you believe to be an expert and is wrong? And how do you not follow someone until it's too late? So I mean, he's mostly just asking about how do I avoid being influenced by other participants in the market or following somebody else's work?
This tells me that you have a weak internalization of your own strategy and style, that you're relying on others because you can't trust yourself. You can't trust your own knowledge and skills. And so if that is not true, right, that you actually do have sufficient knowledge and experience to be able to be profitable in the markets, well, then what you need is to spend some time actually writing down and articulating your trading plan in far more detail with a lot more precision, right? In a way that, if I woke you up at 3:30 in the morning and said, how do you make money in the market? You could tell me instantaneously in 30 seconds, not everything that you do, but like the elevator pitch, as if you were going to try to kind of find investors. You could do that very easily. If you can't do that, then it's going to be very, very easy for you to get sucked into how other people make money and rely on them versus yourself.
That sounds a lot like what kind of trader are you, doesn't it?
That's right. Knowing what kind of a trader you are. Yeah. Anything else, Landau, for Jared?
No, some of the comments were related to tilt. And so maybe you could just talk about how should a trader be incorporating the aspects of tilt into their goals and their overarching plan for the year? What considerations about tilt in general should they do in their pre-year goal setting?
So for those that aren't familiar, tilt is basically just anger forcing you to make bad decisions and ultimately cost you money for the most part. I wouldn't necessarily say that tilt is unique from a goal setting standpoint. Any emotional issue, whether it be greed or fear or anger in this case, or confidence, can be delineated either as a result-oriented goal, right? I want to remove 80% of my tilt from my day-to-day performance. I want to have firm understanding of the causes of my tilt in this year, and feel like I'm making some solid progress in reducing the frequency of it. I think very often we want these things to disappear quickly, and the reality is that by repeating the same process of trying to create band-aids and patchwork, you don't really go very far, and you find little pockets of time where tilt won't affect you, but then eventually it will again. I'm not in the business of management. Managing your emotions to me is a short-term strategy and tactic. Our goal is to actually resolve the underlying problems that are producing those reactions that are tilt. And if you do that, well, then you're going to free up mental capital to be able to trade at your best more often. If you're having to devote aspects of your day-to-day, kind of functioning to looking out for the signs of tilt, well, then there's no way that you can be as present and as focused on what's happening in the markets when you've got kind of one foot or one part of you is kind of like the bouncer trying to keep that stuff out, and then the rest of you is trying to enjoy the party. It just doesn't work that way. You want to have like the full freedom and autonomy to be here, because that's the only way you're really going to be able to access intuition on a reliable basis. Otherwise, so from a goal standpoint, I would say not set yearly goals with it, unless it's like kind of the big overarching, kind of headline. I would instead look at, on a monthly, quarterly basis, what do I feel like is reasonable to achieve? And in a 3-month time frame, it's rare that you're going to truly resolve tilts. You can have a lot of, understanding and certainly a lot more control, an ability to avoid, many of the landmines. But the resolution of it is going to take longer than that. And, sometimes traders, certainly with mental and emotional stuff, kind of want the answers fast, want the solutions fast. They're not willing to put the work in. And so that to me is the beauty of Mental Game Trading Live, is that it gives, you all a chance to actually be able to do the work, with a little bit of supervision, so you're not kind of alone trying to figure it out.
There's a comment here by a member who says, why so many people emphasize psychology when they actually lack skills, system, and a proven edge? I find that comment very interesting, because if it seems, if I had that point of view, that I feel like it's so odd that people talk about psychology so much when they really should be talking about what their edge is going to be and what their system is. And I think it was Richard Dennis in the original Market Wizards who said, I can take a full page ad in the Wall Street Journal and outline step by step what the process is for how the turtles make money. And the turtles famously made a ton of money. He said, most people, almost everyone, will fail to follow it. I think it's a privilege if you are truly someone who doesn't understand why people deal with psychology so much, or emphasize psychology versus executing a trading system. Because for most people, at least, even people that I backed, which generally the people I backed were almost exclusively high performance athletes, tennis players, that sort, basketball players, people who have grit, and we had certain criteria, and only athletes really fit those. Even those people have so many hangups to executing what we provided as a clear edge in trading the market. So I think it is if you're shocked at why psychology is so important, then maybe your psychology is so great that this is not something you have to think about. But for the rest of the mortals out there, you can hand them whatever you want, even if it has great alpha in the market, they just cannot execute it, because it just takes that first loss for them to start going, maybe it doesn't work, maybe this, maybe that. So just understand that this problem, this psychological problem, the problem of executing without having that bounce, or keeping those things out that are interfering with performance, for most people, this is a real problem. So coaching is what brings you along in that process and helps not only recognize the issue, but also provide ways of dealing with it. Landau, we need to wrap up. Is there anything else that Jared might address?
No, nothing in the chat here.
I'm going to jump in real quick, Brian, to say great story. And for those that are looking to kind of find where their access point is for psychology, it's actually look at the repetitive trading mistakes that you make, right? The ones that you intellectually know you should avoid and shouldn't do, but can't stop yourself from doing. They are almost without fail 100% related to something mentally and emotional. And that's like an easy way of identifying where you can kind of find an access point to working on this side of trading, because you obviously know what you should be doing, but if you can't do it, that's how you know that there's something mental and emotionally at play that you don't understand quite.
Very cool. Great points. Jared, thanks for being here as always. Invaluable experience being shared. I invite everyone to check out Jared's website. Go to jaredtendler.com, and of course you have access to the Convergent 20 coupon. I want to point out that coupon is a one-time use. So if you go to jaredtendler.com and go to this program, the Mental Game of Trading Live, and you take a month, you've used up the 20% for a 1-month subscription, and you cannot reuse it. We recommend you check, most things in trading really need about 3 months. We recommend you check the quarterly, and we'll drop the information on that in the chat if you want to check it out. Thank you, Jared, for taking the time this evening and for being with us. Have a great break and a prosperous 2024.
Thanks, Brad. Great to see you, and Brian, John, wish you all well. Doing great work here, and appreciate you having me on.
Cheers, man. Take care.
Here it is.
All right, now we're down to the wire here. We are at the end of our show. We've run over by about 15 minutes. We want to take a moment and discuss with Brian and John a few things about Convergent this year and our experience with the many traders that are members. I want to start out by asking you guys, I'll start with Brian. How's your goal setting going to go for 2024? What are some of the things you're interested in kind of putting at the forefront of your focus going into 2024, if you have anything?
Yeah, so I think, we kind of ran over and asked, I really wanted to ask Jared something that has applied to me in the past. Is I never worked well with goal setting in the past because just maybe too type A personality. And my problem was if I set a goal and didn't achieve that goal, I saw it as failure. So I always avoided setting goals for that reason. Because I had a misunderstanding of what goals actually are and what their purpose is, was the problem. Thanks to Jared in part, I've gotten much better at that and understanding their purpose and how useful they are. So year after year, my goal setting process has gotten more clear each year. Right now, I've got some things going on. We're remodeling the house, and that's in the way of, it's distracting, certainly distracting. So my goals this year will get segmented into kind of clearing those things out of my way, and then refocusing more on work and trading and rounding out my year. But just prioritizing, I guess I would say, clarifying those goals, prioritizing, and then focusing.
Brian, remind everyone how long you've been trading for. You've run the gamut with what you've traded.
Yeah. I think it's 13 years.
Yeah.
The number that comes to mind.
John, what about you? What's you've had a pretty busy year this year. You're very active in the chat room and in the various webinars and so on at Convergent. Do you have any plans to set goals for 2024? If so, can you give us a highlight?
Yeah, for sure. That's really mainly what I do next week, that week between Christmas and New Year's. But just looking ahead from a kind of a technical perspective, I want to work on my position management. Like I always say, like one of the things that I think is a weakness for me is runner management. Like I have no problem holding, but sometimes I hold too long, and that's something that that I'd like to dial in a little bit better this year. But then again, that's also one of those things that no matter, you're always a little bit wrong no matter what. Like you're never completely right. So it's so that it's not like you can be perfect at it. I also want to work on improving my planning process a lot. Everybody sees my plans every morning, and I think that that's a process that I could improve a little bit. So make it more effective for myself and for anyone that might follow along. That'll be a big goal for me. And depending on how next year goes, I may actually entertain the idea of potentially adding a product, like adding a second product. That may be in the works, but I don't know. Those are all decisions I'll make over the course of next week. But those are kind of the three things that I've sort of thought about in a preliminary way that I want to be working on next year.
Very cool. Remind us again, John, how long have you been trading? Where did you get your start and to the present?
My first time I traded a futures contract was I think 2004, but I've been pretty close to the business my whole life. My cousin was a floor trader in Chicago, and I started clerking right out of college in 2004 or so, and went into prop, and was in prop for a long time. Then in my 30s, owned a couple businesses and was away from the markets, and then got back into markets full time. Well, got back into markets in 2018 and full time again in 2019.
Very cool. And your focus right now is the ES, right? Brian's focus is the RTY. Yeah. Very cool. So let's talk about what we like to talk about at Convergent, and it is what the hell happened today? What is going on with this chart? Let me share a chart with you and just turn this off. There's the S&P, there's the NASDAQ, the S&P, which has been chugging along, and let's take a look at it in a TPO chart to see how many days we took back. This has to reload the data because the market closed, and it has to bring in the settlement and everything else. But we've been chugging along for weeks, and we've been grinding up and grinding up and grinding up, and then we took back an entire week today. We dropped almost 100 points. What happened there? I wasn't around to witness this.
Profit taking.
Yeah, there was no news. I thought maybe there was news, but just because the way it happened. But there was no news that I saw. It was just profit taking really. I mean, I said on Monday we get the high of the week before Wednesday afternoon.
I did read
12:55.
I did read later that the market in India was affected supposedly by a new strain of COVID, but I think if that's what was affecting our markets, I think we would have seen something about it. But so I'm leaning towards market profit taking.
Totally. I mean, it's one of those things where just like we just needed anything to sell off. We had went so far.
This is what I'm leaning towards. I'm leaning towards just a cascade of the fact that buyers have been so strong for weeks, and we've been grinding up for weeks, and it's that give me an excuse to hit the sell button type of thing. And it's like Bob said, you know, they all ran into the treasury market out of equities. And that seems like a pretty good position to be in or to fall into before you take off next week. I mean, Christmas is Monday, and then we're gone for the week, and then the following Monday is New Year's, and I don't know. It just looked to me. I replayed the market just to get my head wrapped around it, and you know, I could see how the top was formed. The top was formed beautifully this morning. I chatted about it. I talked about it in the chat room. I said that on the way up, the market seemed these dots here reference time, whereas the profile is not time-based, so it's squished to the left, but these are correlated. But you could see where as the S&P was, as the NASDAQ was pushing up this morning, I'd commented that, man, they are fighting this thing on the way up. And then you could see that there was a big fight up here, and you know, somebody stepped on the gas, sold 240 of them, and poof, and it just disappeared from there. We left very poor structures behind for tomorrow to deal with. Tomorrow should be a very interesting market. We ran away from the point of control. We left the point of control at the highs, and we ended up closing far and away from that. There's a strong imbalance in the market with weak structure above. And I think it's this morning's Trader Bite, I said, you know, if this thing walks itself through the 4802 in the S&P, then we are very likely to see the one time frame, which has been going on for a couple weeks now, come to an end, and it's likely to spill pretty fast. I forget what I posted as a target to the downside, but you know, we certainly covered it pretty quick. If you didn't get on this train early on, it looked to me from the replay that it was very, very difficult to get on it. Is that true?
There were a few opportunities. I thought in the S&Ps, I thought there were a few. The big opportunity was by far the break of IB low to go neutral extreme. I was able to get short before that. This was a big plan of mine. So I was able to get on it pretty early. But to me, once, like I had said, that level, the 4808s were really important right around the overnight low this morning. And it looked like we might push lower this morning. And then we reverted lower. But that's overnight structure. When we broke through the opening swing and then went neutral and zippered outside of the IB, that to me was the clearest opportunity to get on board. That was I thought that was a really good opportunity, good risk reward to get on board the short trade.
Pretty nice looking pullback here.
Yeah.
On the overnight low and the IB low. In the NASDAQ, same structure occurred. We had a collision at the overnight low, little bounce to the collision before it, and then it just ran away from there. Pretty interesting. Did not look at the RTY. How did the RTY treat you today, Brian?
Well, I'll tell you, it looked like it was going to be balanced, and then the number came out, and that was enough to push them to actually break above the 53s, which gave us a new swing high. I mean, that was a pretty key structural level, I thought, and it looked like they had it well in hand. The buyers looked like they had it well in hand. And it spilled off differently though than the other markets did. I mean, they seemed to hold up, and then once they broke back below those 53s, it was over. But you had no reason to really go, oh my God, we're going to lose this thing, until they broke the 44s. And once they broke the 44s, you got a shot at getting short at the open, which would have paid you. But then it was really spilling. And if you didn't get that particular pullback, you were probably just hopefully sitting on your hands and watching, because there was a lot going on after that.
Yeah, it looks like the Russell didn't actually start selling off until, wow, like 45 minutes. Is this right? 45 minutes after the NASDAQ and the ES started to?
Yeah,
Does that seem right to you?
They held pretty tough today. And the bound, they held a key level at the bottom too. They only took back 2 days. really, and they held that 04 level, and now it remains to be seen whether or not we're going to hold. If we don't hold that, there's some thin structure below that we're going to go down and repair. But we'll see.
You know what I really like about what you just said, Brian, and it's kind of similar in the S&Ps, is like, it's not really clear what levels are going to be important, and that's great for us because we just got done with a few weeks of just complete certainty. The market's just like chugging upwards, and it's so boring. And now hopefully this is the start of a little bit more we're going to the holidays, but ideally a little bit more two-way trading, two-way trading, and some nice ranges to trade. So I know I mentioned in the chat room, anyone that's going to trade overnight, there might be some opportunity tonight and potentially a little bit more into the end of the week as we just kind of figure out where this should be priced, because when that's not clear, that's good for us.
Hey, another interesting thing is where they closed it in the RTY as compared to where they closed it in the ES. I mean, they closed right at the bottom of the ES, and in the RTY, they brought it back up significantly.
Yeah, shout out to Max for that NQ over under zone. That was beautiful, by the way.
Russell, what an odd low. Holy cow, look at that. The point of control shifting to the very low. Is this right? Man, that looks really strange.
Yeah, they market on close and Russell was tremendous.
Yeah, very cool. What was your biggest, I want to call it a win for the year in your involvement with Convergent? What is something that stands out to you that to kind of take into the end of the year?
Well, I think obviously the getting that first AP cohort off the ground was monumental.
Yeah, it's what Brian's referring to as the accelerator program, which is a 2-week, pretty intense 2-week program that we took on a group of people on an invite only, and we call it the accelerator program, and it's intended to kind of carry people into the next, carry traders into the next step, create a foundation and a process for organizing the market and setting up your trading plans and so on and so forth. Yeah, that was pretty big. John, anything else that stands out to you for this year?
I mean, I would agree. There was certainly the AP program for me, and just the opportunity to learn, that was amazing, but also to connect with everybody that was in that group, which is just such a great group of traders. And just overall with Convergent, that's really my favorite part, is connecting with other people. I'm here in this office in Pittsburgh. Nobody knows what futures are in Pittsburgh. Nobody, not even my dad. He still doesn't know. And I've been doing this for 20 years. So it's fantastic that I have coworkers again. It's really, that's, for me, that's what that's the most special part about the place, for sure.
Very cool. I really appreciate you guys being a part of it. I also appreciate everyone in the audience who hung out with us and listened to what Bob, Jasper, and Jared had to share. And hopefully we can get together with you soon and see you again. And of course, I want to wish everybody just an absolutely fantastic holiday season and a really prosperous and successful 2024. Hopefully you'll eliminate all of your errors and see a lot more upside in 2024 than you did in 2023. And of course, to you both and Landau, who's always in the background doing all the hard work. I appreciate you all being part of Convergent and being team members. So thank you all for being here. A reminder that I will not be here next week. So we'll finish out tomorrow and Friday, and then I'm out until the new year. So thank you, happy holidays, and we'll catch you guys soon.
Happy holidays, everybody.
Cheers.